When Cisco Systems reported back in November, the company slashed its full-year forecast. Stock got obliterated. Then it came coming back. It just kept going up. Now, I was hoping that management merely wanted to reset expectations, getting all the negativity out of the way ahead of time, and that's what the stock seemed to be telling me. But I guess the stock wasn't telling me the right story entirely, because when Cisco reported for the close today, it once again delivered better than expected results, but it was paired with tough guidance. In fact, they cut their full-year forecast for the second time in a row. Management also confirmed that they plan to lay off 5% of the workforce as part of a broader restructuring. So where's the bottom here? Do they finally have their arms around the problem? Will the new announced layoffs be enough? Hey, let's go straight to the source with Chuck Robbins, the straight-shooting chairman and CEO of Cisco, who comes on the show in good and bad times. Mr. Robbins, welcome back to Mad Money.
Jim, thanks for having me. It's good to see you.
Good to see you, Chuck. Now, you were very straightforward last time. You said, look, it's going to be a bit of a turn. May not happen as quickly as I know I wanted it. It sounds like that once again, after this quarter, you're still not necessarily there in the core business. May not be turning around even this quarter.
Well, Jim, there were three things that we really saw. We saw, first of all, we saw more caution with our customers this quarter than we saw in the prior quarter, which led to our teams actually expressing more caution in their forecast. Therefore, we have more caution in our guidance. The second thing is this whole notion of these elevated inventory levels that we have with our customers. The consumption of all that inventory is taking a little longer than we expected. That's the second thing we saw. And then the third is the continued weakness in our service provider, telco and cable segment, which was down. Orders were down 40% for the quarter. So those three things led us to revise guidance for the rest of the year. But we do believe that we'll get through this inventory consumption issue by the end of 2024, and hopefully the other two issues resolve themselves soon, and we see some good times ahead.
Well, let me put a different spin on it. One of the reasons why I like the story for 2024 is you're buying a company that I like very, very much, and I like the CEO. He did a fantastic job cleaning it up, which is Splunk. And I think once that deal closes, we're not going to be sitting here talking about service provider orders.
I think you're right, Jim. And what we did announce today on our earnings call is that while it's still contingent upon final regulatory approval, because of the pace that we've seen with regulatory approval, we're now going to close it towards the end of calendar Q1 or very early in calendar Q2 is our expectation. So prior, we had thought it would be August or September, so that's certainly much faster than we anticipated. And then we get excited about the opportunity to drive the integration around our cybersecurity capabilities, to drive the integration around our observability capabilities, and we think we're going to bring some very unique solutions to our customers.
At the same time, I saw you with Jensen Huang. Now, I know that people say, oh, come on, everybody's with Jensen. Actually, yes, he is a great spokesperson for AI, but there are deals that are made that are actually additive to the companies that he partners with. I know that when I said buy ServiceNow, when I saw him with Bill McDermott, the stock put on a couple hundred, you were with Jensen. What were you talking about?
Well, Jensen actually approached me about a partnership, and what he really wants to do is for us to partner together to build integrated technology stack that really simplifies the enterprise experience deploying advanced AI workloads. And so we met first in November, and our teams worked for 3 months on defining what that is. We'll take that technology and we'll continue to evolve and build next generation after next generation of capabilities. And then the plan is for us to leverage our enterprise go-to-market capabilities, our sales force, and our global ecosystem of channel partners to actually deliver and install that technology and get our enterprise customers running their AI workloads in a much simpler way. So we're excited about it. We think it's going to be a real tailwind for us as we get going. We think it's going to be a great partnership.
Nobody likes to see layoffs, but at the same time, we saw when Amazon did some layoffs, when Meta did some layoffs, it did change the profitability of the company. Could this 5% layoff make it so that let's say, the earnings decline might be softened?
Well, Jim, first of all, we never make these decisions lightly. As you know, you and I know each other well, and these are very tough decisions, and we're going to be spending time with our employees over the next couple of days just talking through this. But clearly, when you're off plan the way we are this year, because of these issues that we talked about, we have to adjust our expenses, and that's what we've done. So it won't be easy, but we'll get through it.
Now, I've been listening to the conference call of Cadence, and listen to the conference call of Arista, it does seem like to be that there's a bit of an air pocket right here. I'm trying to figure out why, if AI is so exciting and there's so much going on, there could be an air pocket in terms of ordering of equipment that had to do with AI. Any thoughts on that?
Well, we've heard from some customers. Now, I haven't heard from enough to say that this is a definitive trend, but we have heard from some customers that they are they're holding back on some budget to be better prepared to actually invest in AI as they evolve and finalize their strategy. So there could be some truth to that. I think from our perspective, the network infrastructure is largely driven by this consumption issue that we see, and a little bit of caution with all the dynamics going around the world in the Middle East and Europe. And with elections all around the world, I think there's just a lot of things that have people just waiting a bit and being a little more cautious than they were 90 days ago.
Well, last question. I'm concerned about the service providers. I don't know how you can be in a vibrant business with digitization happening all over the place and the speed of change and have that decline of orders to Cisco. It just seems to be that they must think there's much less of a future than I think you and I might have thought of a couple of years ago.
Well, these have been great customers of ours for a very long time, and we spend a lot of time talking to them. And I would say that over the years, we've always seen they've seen complete revenue streams disappear, and then they rally and they resurge. And so I would never count them out. And I think that we spend a lot of time right now talking about different solutions we can take to market with them, focusing on enterprise services that they can uniquely deliver. So I think we'll get through this, and I think over time they'll see the 5G enterprise applications come to fruition, and I think they'll be fine.
Excellent. Well, Chuck, it's great to have you on. Thank you for telling us it is, and I think the real news here in this quarter is that Splunk's going to close sooner than I thought, and then you can really work some magic, Chuck, and I know you will. That's Chuck Robbins, Chair and CEO of Cisco. Mad Money's back after the break.
Coming up, pop open those umbrellas and tee up your toughest questions. Cramer takes on all comers in the lightning round. Next. Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.